Yeah. What's cracking, YouTube? Hold on. Subscribe to the video, y'all. Let's show some love. Stop what you're doing. Let's pause this video. Before we start this video, subscribe to the channel. Show some love, all right? Let's get to 1,000 subscribers, all right? Let's click that like button. Click the subscribe button on the link below, all right? Show some love. I appreciate it, right? Y'all already know the lingo. What's cracking, YouTube? We back with another episode from Trenches to the Riches, y'all. Listen, now today I want to talk about a section that's highly underlooked, all right? Everybody is super bullish on AI and super bullish on technology, and that's all right. But there's a few healthcare stocks that has been underperforming the S&P 500 and the VOO versus the whole overall market and still have room to grow. And I feel like a lot of people miss out on these compounders, all right? And like I said, I want to invest like Warren Buffett. I'm not looking at a stock, a strike. I'm not looking at how expensive it is, how cheap it is. I'm looking at quality business. I want to know, is it a good business or is it a bad business? How strong is it? Okay business or is it an excellent business? All right. This is not financial advice. This is not a signal to buy, hold, or sell. This is just my opinion and what I'm telling you to do. All right. We have a few stocks I want to go over. I'm gonna name them. We got Abbvie, we got Johnson & Johnson, we got CVS Healthcare, we got Pfizer, all right? We got UNH, we got Eli Lilly, Humana, we got ELV, and we got Teladoc, all right? We got Teladoc, and these is a lot of health companies, pharmaceutical companies, insurance companies, all right? And I'm gonna give y'all my opinion on these companies, all right? Now, as far as the companies like Abbvie, Johnson & Johnson, CVS, Pfizer, Eli Lilly, even Eli Lilly, I'm going to just say, I think these is all great companies. Do I think they're excellent companies? No, I do not. Why do I say that? Because of the competition. And these companies go off of making money from drugs. Making money from drugs. I want to be able to deposit my money in places where I know I could sleep at night. Places that I know that it's hard to take my company out the game. They have pricing power. All right? Now, why do I say that with Abbvie and Johnson & Johnson? Because the competition. You don't know what company, right, is going to come out with the next big drug and take everybody out. Everybody know Eli Lilly have the drug right now that's taking market share with the obesity. Anybody that's overweight, you know, you're going to Eli Lilly, you get that shot, you get that pill, drug laws. Y'all know the vibes. All right? Same with Pfizer. This is a perfect example. The pandemic happened. Pfizer shot to $60 a share. $60 a share, y'all. Now it's sitting around $25. They can't raise their dividend. They're paying more money in dividends than they are getting in free cash flow. So let's bring up Pfizer real quick. All right, Pfizer, let's go to the dividends. They have a 5-year growth rate of 4.7%. Horrible. A payout ratio of 116%. So they're using all their free cash flow to pay back to the shareholders. Not only is it 100% of their free cash flow, it's going in to their cash they got on hand. So they can't reinvest the money back into the business to grow the business. They have a 6% yield. This is what you would call a value trap, a dividend trap. You know, for some young investors. Johnson & Johnson as well. They have They have 3.3 yield. They just did a 4% increase. All right, they're a dividend king. They've been paying dividends for 61 years with a 5.75 growth rate with a payout ratio of 4.5. Now that's not bad. They are more of a solid company, all right? They have drugs such as Tylenol, bandages, Listerine, those drugs like that. All right, they have them everyday little drugs that you have in your house that you wouldn't even know, but they're owned by Johnson and Johnson. You have a headache, your stomach ache, things like that. Abbvie, let's check out Abbvie, all right, with the dividend. All right, they've been paying a 8% growth rate with a 5.5 ratio, 3.81 dividend yield. All right. Now, CVS, they have not been growing a dividend either. All right, we're gonna go to dividend. They paying a 31% ratio, a 4.75 dividend yield, only growing 4.9% 5-year growth rate. Now, this is why I say these is okay companies. You could get a great return from these companies, but you have to watch these companies, all right? They don't have huge moats, if that was saying. They don't have a competitive advantage to another company. Which one of these companies have the competitive advantage, right? None of them. One of the companies to come out with the next big drug and be the best top company in the world tomorrow. You don't know which company that is. What you gonna do? Buy all of these companies and then guess, and whatever ones explode, you're gonna hold on to, but you're gonna also have a bunch of other losers. All right. Now, I love the healthcare insurance side of healthcare. All right. You have UNH, you have Humana, you have ELV and health insurance. All right. Now, why do I love UNH, Humana, and ELV? Because these have high moats. Everybody in the world is always going to use healthcare insurance, all right? It's a steady business. Yes, it's competition, but you can't just buy one thing and then take the other competition out. Abbvie have a drug, the Humira drug, that's about to be taken off their list. Their highest selling drug, bringing in about $10 billion, all right? Another company is coming out with a similar drug in 2025, in February 2025, all right? And that could just take out billions of dollars from Abbvie in 2.5. We don't like that. You can even look at the 10 year. Look at 10 years of UNH, 544%. Let's look at the 10 year from a company like CVS, negative 26%. Let's look at the 10 year from a company like Johnson and Johnson, 47%. All right, let's look at Humana. Even though they just crashed about 30%. In the last 10 years, they're up 1,500%. These is money making machines. These is compounders, companies that's bringing in revenue. Yes, it's slow, it's steady, but you could sleep at night with these companies, all right? Warren Buffett loved to invest into companies that have huge amounts of free cash flow, huge amounts of piles of money. Just like Charlie Munger, they love these companies that have huge amounts of cash on hand. All right. So, in my opinion, I love UNH for a buy. I love Humana for a buy. I love ELV for a buy. Of course, I would love to get in with a margin of safety of about 10, 20%, even 30, 40% if flash crash happened, all right? A black swan event happened. These is the companies that I want to buy on the dip, not those companies. I'm not chasing dividend yield. I want to make smart investments, not dumb investments, all right? Now, Humana and UNH, they've been growing their dividend. They're paying about 29%, growing 15, almost 16% of 5-year dividend growth rate with a 1.5% yield, and they've been growing it for 14 years, all right? That looks way much better than Johnson & Johnson, Abbvie, and Pfizer that have less than 5%. There's no growth there. There's no growth. Last stock on the list, not least, but Teladoc. All right? Now, everybody say yes. You want to invest in a high quality cash compounders, all right? And yes, I do want to invest like Warren Buffett. But I also want to invest, I'm young, all right? I'm young and I want to take a little bit of risk. But smart risk, all right? And Teladoc is a company that I love for the long term. I love it at $12.66 per share, right? They're the top healthcare company in the world for online healthcare. You can see a doctor from the phone. You can see a doctor from a laptop, a computer, anywhere. They could send drugs to your house. All right, they're down 54%. All right, they just IPO'd maybe in 2015. Kathy Wood hyped up the stock. The pandemic happened. Yes, I know that. It went from $230 to $300 all the way back down to almost $12 a share. This company is acquiring new companies, all right? People may say, hey, they're not growing, all right? They don't have no free cash flow. They're not a positive company. Now, they just acquired another company. If they didn't acquire this company, there will be positive free cash flow, all right? There will be a company that's making cash flow, all right? I feel like Teladoc is going to be like one of these companies that's going to take long to build, but along the way, they're going to acquire different companies to fit under their radar. And then they're going to slowly grow into a beast. Watch out for this company. A lot of people was hyped up, not talking about this company. People want to talk about the company, whether it's at $300, $200, $100 a share. Talk about it right now. Why is that $12 a share, $10 a share? I'm investing into it. I love it. Another episode from trenches to the riches, y'all. Let's get this money.